Pratik Agarwal represents ASK Investment Managers. Pratik, Indian markets in quick time, on Nifty in quick time has appreciated from 5300 to 5450. So what is fueling the underlying momentum? Global liquidity or pre-budget expectations?
Primarily global liquidity. We have had an LTRO2. We did expect that around this time we would have monies flowing in. So that was what our case was, that you had two large events, the UP election results and the budget, and just because the monies from that kind of an event would start to flow around and kind of match in terms of time frames, we really thought these events would not be showstoppers. The second important thing is, while there is money coming in, even now, if you look at average valuations that the market has been trading over the past several years, we are trading lower than that. So on valuation side, we are comfortable at this point in time. Lastly, while let's say in a December kind of a period, there were large concerns on the budget, especially taking into account the amounts which may be provided for food security bill. I think just before the budget, those concerns have largely been taken care of, versus 1.5 lakh crore that some quarters were talking of that could be provided for the bill. Now the expectation is less than 30,000 crores. And given the fact that oil prices may be at the peak and fertilizer prices may have already started dropping a bit, chances of subsidy bill being where it is, even after accounting for food subsidy, is in the realm of reality for next year. So I think we are pretty okay going into the budget season as well.
The one pocket that really shot up quite smartly in trade yesterday was the entire infrastructure and cap goods space. Pratik, what is the expectation? You think the finance minister this time around could clear some bottlenecks for infrastructure as well as infrastructure financiers?
This space always moves up before the budget, but in the budget you may have higher allocations for some of these centrally governed schemes. Most of what the companies in the listed domain do are basically PPP and NHAI kind of projects, which don't find any place in the budget. On the financing side, there may be higher tax withdrawal for deposits into tax-free bonds for infrastructure, that kind of stuff. So maybe to some extent that may be a positive, which can be expected out of the budget. But I don't believe that budget would have anything directly positive for infrastructure companies. For several years we have seen this pack move up sharply before the budget, but only to be disappointed after the budget. But frankly, infrastructure companies may not be going up because of budget. This is a space which is highly levered, which is trading at a fraction of the valuations that it traded similar time last year. And going forward, if rate cuts is the big theme of this year and higher liquidity is the big theme of this year, frankly, the fundamentals may not change much, but this is the pack that may just end up doing well. And in terms of investing, that presents a pretty large challenge.
Will your portfolio strategy change because of the budget outcome, or you are likely to remain fully invested even after the budget, irrespective of the budget outcome?
I think views can change after the budget, but that said, we are fully invested and we would continue in all probability to be fully invested after the budget, because at this point in time, at least the view that I have is that it's easy to project a number of 5.3 on fiscal deficit. Okay, and if you do that kind of a number, then you are basically saying that the total subsidy bill would be somewhere similar to last year. And like I said, chances of improving on that would be higher. Okay, so I think the street would wear around and say that 5.3 is probably a conservative number and the government will end up doing better than this. That would be a positive. If suppose the number presented in fiscal deficit is lesser than 5%, 4.8 kind of a number, then there may be some amount of skepticism on the street, but per se the number would be taken positively. So, given where the valuations are lower than the average, if valuations had been higher than the average, then I would have reasons to, be more concerned. But where valuations are at this point in time, I really believe the outcome has a good chance of being positive rather than negative. And I wanted to take half a minute on that infrastructure theme. Just to make a point, I was interacting with a company which had a few road projects. The company says that at this point in time I can service the interest on all the projects and principal repayments for all but one of the projects. Okay, and if interest rates go down by 0.5% to 1%, then I can service interest and principal on all the projects. Okay, so just to give you a sense, the drop in interest rates has a huge impact on infrastructure companies which are currently the largest asset owners in this country. If there is a drop in interest rate, hence the valuation upside in this pack may be just the highest.
So what do you like within that pack? Do you like asset owners? Do you like pure builders?
That's a difficult one.
It's an easy question. I mean, I'm sure you've done your homework.
We have done the homework, but fact of the matter is corporate governance issues in the past prevent us from taking any large bets on this space. We are happier playing this space through infrastructure lending institutions because it helps them as well. If there is a rate cut, then the incidence of NPAs on lenders' book would be much lower than otherwise, and that is actually the case for expecting a rate cut soon. So it's better to play through infrastructure lenders, maybe through trading companies, but not exactly through reality or engineering companies at this point in time.
If I check on the institutional activity in last 2 or 3 days, domestic institutional investors, they've turned net buyers, and domestic institutional investors were selling this market down in the month of Feb and early part of March. What is the importance of that data?
Basically, it kind of means probably that government is not selling anything in the near future. The selling was primarily from large Indian insurance institutions for that kind of an event. I really thought most of the mutual funds and most of the private sector insurance companies would have been buyers. To give you a sense, there were some of the private sector insurance companies which were sitting on 20% kind of cash to my mind, and they are not sitting on that kind of cash anymore. So there has been overall significant amount of investing that has happened between January and now. The selling that we have seen is probably on account of bank treasuries, where CD rates go to 11%. Chances of them booking some of the profits, some of the equity profits in their treasury book would be high. So that may be one source of selling. The other source is clearly the large public sector insurance institution.
What do you like within the banking space, Pratik? Last time when we interacted with you, you said you had a mixed opinion. You like private banks, but you were not so sure about PSU banks. Now that the underlying assumption is that rates in the system will correct, would you be buyer in large cap PSU banks?
We have stopped looking at the banking space in terms of PSU versus private. Primarily, if I have a minute, I can explain my position here. We have had the Basel III norms come out proposed by RBI. While they may get changed a bit between now and 2017 when the full effect will come into force, what they do is lower your targeted leverage by a very large amount. So, if you have de facto equity at 11.5%, in 017, the max leverage that you can go is around 10 times, not more than that. Which means that for banks which have ROAs of less than 1, the max ROE, return on equity, that they will make will be 10% or less. So for those kind of banks, I really don't know what kind of investment case there is. Lot of them, most of them would fall in the PSU space incidentally. Even the private sector banks who have,
So what is the simple definition here? I love your explanation, but it may sound slightly complicated.
Simple definition is, look at banks who have return on assets of more than 1.5. Most of them would be in the private sector space, 1 or 2 would lie in the public sector space. Look at banks who are full service banks and they have, let's say, a profitable AMC, a profitable life insurance company and a brokerage, because these are fee-based income and add to the overall attractiveness of the franchise. And not look at banks which are standalone in nature. So, some of the large private sector banks would be standalone in nature and, they definitely go down the attractiveness list. So, one should look at names which have a broking, a mutual fund, a life insurance and profitable franchises. And that is our way of thinking at this point in time.
Which is one group, one cluster where you are ready to allocate disproportionate amount of money, and we are confident that if you put in 100, after 1 year you will get 125 back.
At this point in time, a big theme, apart from the domestic stories and pharmaceuticals, etc., to play out is the stability of Europe. So companies which are exposed to the Eurozone, and that may be, companies in the power equipment space, it may be auto companies, it may be steel companies, would benefit from the stabilization, normalization of that region, at least in terms of perception. So we really believe that kind of a space could do well, and we are also very, very hopeful, like I said before, in the talk, on companies which are asset owners primarily in the power space or in the road space.
Do you own airlines? Do you think the risk-reward ratio right now is in favor of going long in airline stocks, because the entire Indian aviation sector now is available at a market capitalization of less than 4,000 crores?
Yeah, less than the luggage manufacturers probably. So, the market cap is not there. What stumps me is that there are very few players, and yet they keep competing for increasing capacity and lowering prices. Why is it so difficult to just increase prices on an average by 1,500 rupees and, at least everybody would be profitable? We don't see that happening. The ticket rates, as soon as you go to yatra.com, makeMyTrip.com, don't seem to be moving up at all. So while as a traveler I am happy, but in terms of business, unless they can price their product a bit higher and hence make incremental profits, I think banks are closing onto this industry, saying no further loans, and that is making things very, very difficult.